This is Trader's Workshop with Adam H. Grimes. Hello, and welcome to episode 16 of Trader's Workshop, Randomness, Why It Matters, and How to Understand It. So this is the last of the series of podcasts that I'm reissuing from the old podcast, and this also is a very important episode. I have to say, not a week goes by that I don't get some email from somebody who says something like, I took the trading course and you talk about the market moving randomly, and obviously that's stupid. Don't you realize that people don't place trades for random reasons, so the market can't move randomly? Now, while I understand what the person is thinking, it also points to some very important misunderstandings about what randomness is and how it's a difficult thing. It's a difficult thing to get our heads around because it's very counterintuitive. In fact, it's something that a lot of research suggests, and I personally believe it's something that we are very poor at understanding as humans. So this is an important episode, and I do hope you enjoy it. So today we're talking about a very important topic: why randomness matters. And I got a question from a listener, Alex, who was talking to a friend of his who happened to be a physicist. And let me just read Alex's question to you. Quote, I presented him with some market statistics that seem to hold true in many markets. Example, that the market has only a low probability to hit yesterday's high and low in any given day. My friend argued that in order for a statistic to be significant, I'd have to test it on randomly generated market data. Only if the random data does not show the same tendency, a statistic can be thought of as showing a bias. Do you think that my friend is right? Are statistics only significant if randomly generated data does not show the same tendency? What if both real historical data and random data show the same tendency? I'd love to hear your thoughts on this. Best, Alex. End quote. So, Alex, the short answer... There's a short answer and a very long answer here. The short answer is yes, your friend's absolutely right. That for a statistic to be valid, for a market statistic to be valid, it needs to be something that we do not see in random data. And in fact, a lot of our thinking about markets and about data really centers around this question. And frankly, a lot of the discipline of statistics centers around that question. So your friend is absolutely right. And if real historical data and random data were to show the same tendency, then you probably do not have a tendency. That's the short answer. Now, the longer answer, this is a question that I can really relate to because a little bit of my history, most of you are familiar with this, but my formal training, I was a musician. And while I think I had a lot of good tools for dealing with the market, I did not have a very strong quantitative toolkit. So I came to this whole idea of understanding the market without really knowing a lot. Just to be blunt, there was a lot more that I did not know than the few things that I did know. Now, many of you have an advantage already, and many of you listening to this do have strong quantitative backgrounds, and you'll understand some of the ideas behind my explanations, I think. But I want to kind of lead you down the journey that I went through to really understand this. And if depending where you are, you'll get different things out of this. If you do have that strong background, then maybe I can help you kind of flesh out some of the intuition around it. If you don't, then do not fear, because you can get the background and the tools that you need, and I'm going to show you some important ways to do that. I'll also tell you a personal aside here. This podcast was really hard to record. I kept getting lost and did it several times, and one of the topics that I got lost in, if you'd like to hear more about, I'll mention later, and just send me a note. And if there's enough interest, it's a little specific, but if there's enough interest, then maybe I'll do another podcast on it, or maybe a video blog is better, but we'll figure that out. So let's jump right in. Why does randomness matter? Why do we care? Well, the short answer is that randomness is the enemy. I came up with that several years ago when I was giving a lot of presentations and talking about a lot of what I would call garbage in traditional technical analysis, where people just make all of these assumptions with no real no foundation. I don't have to qualify it. That if we were to compare many of these things that people think works with random data, we don't really find anything. And why this matters is because if something is random, we can't make money with it. So we're going to talk a little bit about that. We're going to dig into understanding randomness a little bit more deeply. And along the way, I'll share some of my own journey. So what does it mean to be random? I guess if I'm going to do a podcast, I probably should have gone and gotten a dictionary definition, but you can do that. If you wish, you can go get a dictionary definition. You can correct me, but I would think that a good working definition is if something is random, it has a lack of a pattern. A lack of a pattern that we can see or tease out, and it just appears to be without a pattern. Now, this is actually kind of a deep topic because there's no way to conclusively look at something and say it is or is not random. If we knew, certainly without knowing the process behind it. For instance, imagine that I show you a series of numbers 1 1 1 0 0 0 1 1 0 0 1 0. Now, is that pattern random? Well, no, it certainly appears there's a pattern there, right? However, what if I told you that I sat and flipped a fair coin for a long time and came up and I just pulled that pattern out of the middle of the random data? If you know the process behind it, then you will, you see that could very well be random. It certainly doesn't look random. And if we applied statistical tests to it, it would, it's a very small sample, but we would probably conclude that that was not random, and it could have been. So if you aren't used to thinking like this, just be aware that there's no way to really test for randomness. What we can test for is for some evidence that it's not random. And that's our thinking. We look for patterns. It just given a data set, it's impossible to conclusively say this is random, but it's very possible to say here's evidence that it's not in many cases. Now, why do we care about this so much in the market? Why is this such an important topic? As I said before, it's because if something is random, you can't make money with it. Now, and many of you right away, you're saying, well, okay, what are some of the things going through people's heads? I think you can imagine, right? People say, well, I'll use a stop loss. And one of the common plans is, and I've had people argue, I've had some like Facebook, I don't even want to use the word fights because I didn't participate, but let's just say I've had people have passionate reactions and tell me that I'm a complete idiot. When I say you can't make money if something is random, then they'll say something like this: well, I don't care if it's randomly going up and down. I'll just get in and I'll put a tight stop. So I really limit my losses. I'm going to let my winners run, and that will work in even a random market, right? Wrong. Another thing that people are probably thinking or have thought is money management. I'm going to use some money management plan that's going to be my edge. Well, even with perfect discipline, great money management in a random market, you can't make money over a large set of trades. Now, that's a problematic statement because, of course, through the luck of the draw, anyone can make money. Somebody who knows nothing about markets can go in and make a trade, make a lot of money, right? And beginner's luck, it happens. And the reverse happens too, by the way. You trade long enough and it will happen to you. You can be a highly skilled and trained trader with a very good system, and just by the luck of the draw, you cannot make money over an extended period of time. It's just the way it works. One of the ways to think about this is imagine you play the classic waste of time, stupid statistical game of sitting down with a coin, flipping it. If it comes up heads, you get $1. Comes up tails, you pay $1. And if you play that game for a long time, what you would find is that there aren't very many points in the game where you are at zero. At any point in the game, you're likely to either have a pile of cash or owe a pile of cash. So if you just look at a snapshot, a single point in time of somebody's trading. There's a guy with the ultimate example of somebody with no edge. He's just flipping a fair coin, but you might walk up to him a million coin flips in, and he might have a pretty big pile of cash. So we need to understand something about sample size and how things are distributed to really understand it. So when we say somebody cannot make money, what it really means is you can't make money with any kind of reliability over a large sample of trades. That guy flipping the coin, it's random. If you are trading with an edge, then with a proper edge and the whole system has an edge, then more likely than not, your equity is going to continue to increase. Specifically to some of the examples. So if you imagine a market bouncing around randomly, that's kind of the market equivalent of the coin flip. And let's just use points. Let's just talk points. Let's say the market's bouncing around and you get into the market and you put a 1-point target and a 1-point stop. And if you're thinking this is a little bit hard to visualize because you're wondering, is a point a big move in the market or is it not a big move? Well, it doesn't really matter. If we're going to do this over and over and over, what you're going to find is you win on about 50% of your trades. Now, the plan that some people have that they will say, oh, let me increase my stop size relative to my target. And it doesn't really matter how you do that. Maybe you make the target 1/2 point, or maybe you make the stop 1/2 point, leave the target at a point. Did I just say that backwards again? I don't know. But, another possibility is to leave the stop at 1 point and make your target 2 points, something like that. So you have a bigger target than your stop. What you will find in this example, if the market is truly random, is that your win ratio will adjust. So if your losses are small relative to your infrequent winners, this expectancy formula, which most of you are probably familiar with, is the probability of a win times your average win plus the probability of a loss times your average loss. That plus works if your losses are sign negative. Obviously, you need to subtract. You subtract your weighted average loss from your weighted average win, and that equation will be 0 if the market is random. And nothing you can do in a random market would change that. That, to me, is one of the key understandings and intuition about trading. And many people struggle with it. And when I say that, I don't mean to criticize anybody unduly, but it's not an easy thing to accept, because at first it isn't an easy thing to accept that you have to have some edge over the market. Some edge over the market has to be possible. If the market truly does move randomly, then we can't have an edge. The general academic consensus, this is kind of important, is, it's very interesting because people do studies of markets, and traders tend to be very dismissive of this work. And I'll just tell you, I think that's a mistake. You'll hear traders say things like, it's just theoretical, ivory tower, academics, throw in whatever, today they probably say snowflake or something, because apparently that's the insult we fling at anybody who we think is irrelevant. But we think that, or traders tend to think that academics are so far detached from reality that their work is absolutely invalid. I think that's a mistake, because what you have with academic research is a lot of smart people who are highly trained, who devote a lot of time and energy to thinking about and focusing on the problems in financial markets. And if they do this in a way that might sometimes not be practical, it's still a valuable perspective, and you should at least understand it. Let's at least say that if you're in this camp of traders that says all academic research is crap, I'm not going to waste my time with it, you're in a dwindling group of traders, by the way, because people are going out of the market in different ways. But if you want to be like that, then I would at least throw the argument back to you. Fine, but ignorance is not a defensible point of view. You know what I mean? You can't dismiss something without understanding it. So you should at least dig into it a little bit dig into it a little bit more deeply, I think. The general academic consensus is that markets move pretty randomly. And there does seem to be some difference with time frames, some significant difference. At longer time frames, say we're looking over at weekly or monthly returns, markets tend to be more random. In the short term, particularly high frequency data, intraday data for traders, those markets tend to have significant departures from random walks. So that points to where we might find a better edge. And this is why, of course, on shorter time frames, transaction costs will increase. But it seems, based on a lot of the academic work, which, by the way, is borne out by a lot of trader experience, that if you're looking to develop an active trading system on a weekly or monthly time frame with stocks, it's probably harder than if you're working on a shorter time frame, say daily. And I think the difficulties multiply, I guess would be a better way to put it, with imprecise way to put it, with intraday data. But the shorter time frames appear to be a little bit less random. Now, it's also interesting, I want to point out, let me actually pull up the title here so I tell you the right paper. You might Google a paper. Is it real or is it randomized? A financial Turing test. This was published in 2010. Very interesting academic study here. So you have all seen, and I've produced them for books and reports and presentations. You've seen examples where the presenter shows you multiple charts and says, some of these are random, some of these are real market data, and can you pull them out? The usual thing we're supposed to assume is no, we can't. That the squiggles of a market moving around look kind of like the squiggles of random data. Now, this paper, however, they ran a project called Aurora, and I think the website is down, but what it did was presented people with two windows at the same time. One window was actual market data, and the other window was random. It was randomized market data, but it was random walk data. And then the people were asked to choose which was real and which was random. And the paper shows overwhelmingly that people with not necessarily any experience with financial markets, but just people in general could learn that game very quickly and very effectively. That, and to me, it's a pretty conclusive proof that people can distinguish real market data from randomly generated market data. There are also some other studies that look at humans looking at market data and basically being able to extract intention, to be able to understand. And all of this points to some very powerful processing that's happening in that big wet computer between your ears. There are things that it doesn't do very well. And one of those things, frankly, is understanding random data. We have a lot of false intuitions about randomness. And I would argue, and have argued, that one of the reasons might be from an evolutionary standpoint. There was probably no bonus for the guy who could really understand random data, where the guy who would immediately jump to conclusions about a sound being tiger claw or a warring tribe or something, whatever, that people who made those quick decisions based on limited data probably survived, and evolution could have selected for this, where with randomness, now we need it in that intuition in the financial markets, but we're very poorly equipped as humans. And again, that's nothing that I don't think we can really overcome that with training. It is a fundamental element of human cognition. So there are things that we're not so good at, but there may be some very complex processing that goes on that we can't even understand. And the abstract of that paper, let me flip back to it. They're talking here. This is from the abstract. We suggest that such novel interfaces can harness human capabilities to process and extract information from financial data in ways that computers cannot. Now, that's not that may not seem to be a very exciting phrase, but it actually is. If you think about it, extract information from financial data in ways that computers cannot. So those of you who are worried about the HFTs taking over the world and the quants taking over the world, perhaps there's an edge there for human traders. One of the problems, by the way, with doing quantitative work on market data is that the sample sizes are quite small. And this is less of an issue if we go to intraday data and tick data, but even with a long time series where we're looking at daily data, you're probably only going to have a few thousand data points. And even if let's say you're doing research on stocks and you have a few thousand data points and you try to multiply that by 50 or 100 stocks, well, there's such tight correlation that your sample's not quite as big as you think. So if you come from another discipline where you're used to having a lot more data to analyze, and this is the case in many of the physical sciences, just be prepared that in financial data, sample sizes can be an issue. If that went over your head, then just ignore it, but something to consider. So how do you actually do this? Well, I suggest, and I'll tell you that something I spent quite a bit of time doing was looking at random charts. And I say looking at, I mean looking at in different ways. It's one thing to just look passively at the chart. It's another to look for patterns. When way back in the day, when I still thought there was something to all this Fibonacci crap and I'll just go ahead and say that. I'll put that out there. And I was working with some even crappier approaches with some mystical ratios and numbers and stuff like that. I would look for those in random data. And many of you may have some pet trading patterns. We all do. If you, for instance, trade breakouts, maybe look at breakouts in random data. And it's interesting to see not only what you see in the random data, but what you don't see. And this will help orient you back around in an intuitive way to what might actually be important signal in the data is distinguished from the random noise. So definitely looking at this, and another thing that you'll get out of this, frankly, is an appreciation for just the things that random data can do might surprise you. Now, that's not really a meaningful statement, but it is. Quantitatively, I don't think is a meaningful statement, but practically it is. I've seen many, many traders look at a chart or look at an order book and say, oh, I'm sure I know what's going on here. I know what this guy is doing. There's somebody pushing it around. And in many cases, I would argue that that person is probably just responding to random fluctuations. And if that person understood randomness better, then they would always have that thought in the back of their head, maybe this is just a random event. And that has implications for risk management. Because if to me, that tempers me emotionally. I may see a picture perfect setup, a beautiful trade, but there's never any case where I would, quote, go all in or where I would violate my risk management rules because I know that even an apparently perfect trade could very well set up purely due to random fluctuations. How do I know this? Because I've seen it on random charts that I've generated. So you get that. And there probably is, over a long period of doing this, there's probably some implicit learning, some stuff that we can't exactly understand. But when you're looking at the contrast between real and the randomly generated market data, I think it will do something for your chart reading ability. It's a little bit soft. It's a little bit hard to nail down, but it is there. So how do you do this? Well, Excel is your friend. Microsoft Excel is your friend. And particularly new versions of Excel, now you can build spreadsheets that have millions of rows. So you can get pretty big data sets. And let me kind of lead you through a 4-point plan here. And I think this is very achievable. This is very easy. If you are completely inexperienced with Excel, you've got some groundwork to do, but I think you can do it quickly. I think you can accomplish this from scratch in a few days, not months. So the first thing to do would be set up a timeline. And you could do this anyway, but I would certainly do it just going down in columns. I would make a number, 1 to 10,000, however many quote days. Let me speak in days, but you can think ticks or 1 minute bars or whatever you want. But let's just assume each row is a day. So think about how many days you're going to generate, and then put a random formula in each cell, which basically is a coin flip. And you figure out how to get 50% so that it's up 50% and it's down 50% of the time. And run that and then graph it. And probably the easiest way to graph it would be you can do this in different columns of each row. So the first column is the counter, the number. The second is your random coin flip, which will probably be a number between 0 and 100. And then the next column could be a column that turns that random coin flip into a 1 or a -1. So in other words, if it comes up, 0.5 or greater, we would want to have a positive 1, and if not, then we'd have a -1. And then you have another column, and this is the column that you graph, where you simply keep a running total of that negative and +1 column. That's your random market data that will create your chart. So that's one way to do it. That's probably and yes, there are all kinds of issues with random number generator in Excel, but that's a separate discussion. It's good enough for what you're doing here. And then the next thing that I would do with that, and we're still in point 1 here, is to create a variable where you can experiment so it's no longer 50%. So by changing one cell, you can make all of those go to 52% or 55% chance of going up. So you're still going to have a random walk, but now it has a baseline drift. And by the way, that argument that, stocks go up 7-8% a year on average, therefore they don't move randomly, well, that is true. And by the way, that's why indexing works, and why indexing probably is a very responsible and logical investment plan. That then becomes the hurdle rate for any active trading strategy to beat. You got to do better than buy and hold. And this is a way that you can generate random charts that have that baseline drift. It is very interesting when you do this. You can set to 55%. So there's a 55% chance that it will come up +1 on any given cell. And you'll see, I would look at it in different time windows. If you look at the long data series, it goes up. But you will also find, quote, bear markets. You'll find very long and violent periods of downtrends in this upwardly biased market data. Food for thought, right? So that's step 1. Step 2 is, rather than having a +1, -1, you draw from a normal distribution. And so you take the standard bell curve and you have your mean of 0, and you got to figure out, you got some decisions to make here. Basically like what's the standard deviation? How spread is that? But what you're just doing then is for each day, you're saying the day's return, the day's percent change is drawn from that normal distribution. Now, market data we're very well aware, is not normally distributed at all. So this is not quite a valid way to imitate market data, but it is a valid approach to creating random data. And I would do the same thing: graph it, look at it, play with it, change your parameters, and just play with it. Play with it and look at tens, at least, maybe hundreds of charts, and just spend some time being a chart nerd with your random charts. I did it for a long time. Number 3 is a mixture of normals. So what this is you would have a one normal distribution that is pretty tame. Like, let's just say most of your days are up and down, between 1%, but then you have another normal distribution. There are a lot of different ways to do this, but here's one way. You have another normal distribution, another bell curve, but it's much more spread. So let's say your average day here might be plus or minus 5%. And then you have a third variable that decides which one of those you draw from. So maybe it draws from the tame one 95% of the time or from the crazy one 5% of the time. Like I said, a lot of different ways to do it, but that's just a very easy way to, and you can Google mixture of normals, you can play with this, but you'll find that this starts to get you much closer to real market data, and you'll start to see some pretty crazy things in this market data, in this random data that you generate from mixture of normals. So that's number 3. Number 4 is, and here's where things get really interesting, and this is actually what they did for Aurora. So if you've stuck with me for this long and if you played through this long enough, one of the questions is, well, what number should I be using for my mean return and for my standard deviations? And what you probably have done by the time you get here at step number 3, you probably said, okay, well, let me look at the distributions from the market. That's the best answer, right? You might look at crude oil or S&P, and you might say, okay, here's my average return, here's my standard deviation, and then you plug those into your simulation, so you start to get closer to real market data. That's a pretty good way to do it. An even better way to do it is to take real market data and break it up and shuffle it up. So the way to think about this is each day's bar. And the reason I stumbled there was thinking about exactly, I was going to suggest it's basically like cutting the chart up, but that's really not what it is, because what we're looking at is the change from the previous close. Let's forget high, open, high, low, and let's just look from close to close. So what you have each day is a % change, a return, and they come in a time series. Time series just simply meaning they're ordered. This day followed this day followed this day. And what you do is you cut that chart up and you no longer have a time series. So you still have the same returns. You still have the same % changes, but you scramble them up. And you can scramble them up and draw them with or without replacement. So you could be drawing the same one over and over, or you could be drawing the same one at a time and it's gone, and different pluses, minuses for doing each way. But this is a way to replicate many of the trading characteristics of the market with purely random data. And it's, we just simplified close to close. You can do the same thing. Rather than just looking at that data point close to close, with each day, you can then express the high as a % change from the previous close, or the previous high too, I guess, and the low. I would go with the close. The high from the previous close, the low from the previous close, and the open. And you can create candlesticks this way, scrambled. This is really probably where you want to end up spending a lot of time with, and spending a lot of time with this. And you can, of course, look on different time frames. It's one thing to take a 5-minute S&P chart and scramble it up. Overnight gaps, hello, that's something to think about, and you got to figure out how to deal with that. If not overnight gaps, then inactivity overnight, because the trading ranges we see at 4:30 in the morning New York time are quite different than the ones we see at 9:35 New York time. So you got to think about that. But intraday data will look very different than daily, weekly, monthly, and you got to figure out what time periods. You go back to the 1960s, use the last 5 years, whatever, right? But using that plan, spending some time looking at that, it's a pretty good way to build some intuition. And those are the best ways that I know to create a large set of charts relatively quickly and really spend some time digging into it. Now, Alex, you can test your statistics on this data. You can, if you are a discretionary trader, you can slap a moving average and your Bollingers and, go nuts, your RSI, stochastic momentum, whatever garbage you want to put on it, look at your Fibonacci ratios, whatever you want to do. You can do anything you want. And then what you will see, hopefully, is what you're pulling out in the real market data that is not there in the random data. And you will need a pretty large sample size just because anything happens sometimes, and you need some way to begin to say, okay, I'm seeing this a lot more in the real market data. And by the way, statistical tests, significance tests are designed to get you to this point. I just talked for half an hour, and there are very well accepted statistical tests that will answer these same questions for us in a little bit more concise way. So I hope that was useful. I will tell you the part that I got sidetracked with when I recorded this a few times before was looking at the opening range, because there's a misconception that the opening tick occurs much more often near the high or low of the day. This is true. That is not a misconception. That's true. The misconception is that does not happen in a random walk market. So that is evidence that the market is not a random walk. That is false. And there are a lot of books that talk about this. There are a lot of gurus that talk about it with quite a bit of authority, but they're wrong. And they're wrong because the opening, if we understand random walks, would cluster near the high or low. And, I'm happy to talk about that in more detail. If you want to know about it, send me an email. If enough people are interested, then I will I'll go ahead and either do another podcast, or like I said, it might be a video blog. So hope that was useful. I know it's a little bit more cerebral and technical than a lot of my podcasts here. May need to listen to it more than once. If you have any questions, let me know. And, again, I was speaking with a good deal of imprecision. So if I oversimplified something or even misspoke on something, I apologize for that, but I'm sure someone will let me know. Hope that was interesting. I hope it was useful. It turned out to be a little bit more of an in-depth and meaty podcast episode than some, but I thought it was especially important and good to reissue here. So I'll be back with the next episode, more or less live, and I would like you to go check out my blog, adamhgrimes.com. Also, wherever you found the podcast, leave a review, subscribe, like. Much appreciated. Tell everybody you know, and I will see you back very soon. Thank you very much.